Two people walk into an accountant's office. Same age, same income bracket, same family situation. They both earned $180,000 last year. The first person walks out having paid $42,000 in federal taxes. The second person walks out having paid $28,000. That's a $14,000 difference for doing essentially identical work, living essentially identical lives. The gap isn't explained by tax evasion or aggressive schemes. It's explained by one person understanding a specific provision in the tax code and the other person having no idea it exists. That provision is the health savings account, and if you're not maximizing it, you're voluntarily writing bigger checks to the IRS than necessary. Today, I'm walking through exactly how this works and why financial advisors consistently rank it as the single most tax-advantaged account available to Americans. Let me start with what makes this different from every other tax-advantaged account you've heard about. Most retirement accounts give you one tax benefit. Traditional IRAs and 401ks give you a deduction now but tax you later. Roth accounts tax you now but give you tax-free growth. The HSA is the only account in the entire tax code that gives you 3 separate tax advantages simultaneously. You get a deduction when money goes in, reducing your taxable income today. You get tax-free growth on investments inside the account. And you get tax-free withdrawals when you use the money for qualified medical expenses. This triple tax advantage doesn't exist anywhere else. It's not a loophole in the sense of some obscure technicality. It's a deliberate feature of the tax code that most people simply ignore. Here's the part that changes everything once you understand it. Unlike flexible spending accounts that have use it or lose it rules, HSA money rolls over indefinitely. The account follows you regardless of job changes. And after age 65, you can withdraw for any reason, not just medical expenses. It functions exactly like a traditional IRA at that point, except you already got decades of tax-free growth on medical spending. Most people treat HSAs like checking accounts for medical bills. They contribute just enough to cover this year's expected healthcare costs, then drain the account paying for prescriptions and doctor visits. This approach captures maybe 20% of the account's actual value. You get the deduction, but you miss the compounding and you miss the long-term tax-free withdrawals. The sophisticated approach looks completely different. You max out contributions regardless of your current medical expenses. You pay all medical bills out of pocket from your regular income. You invest the HSA money aggressively in index funds and let it compound for decades. You keep receipts for every medical expense you pay out of pocket, because here's something most people don't know. The IRS puts no time limit on reimbursing yourself for past medical expenses. Let me walk through exactly what this means. You're 35 years old. You max out your HSA contribution at $4,300 annually if you have self-only coverage. You invest that money in a total stock market index fund averaging 8% returns. You pay your annual $2,000 in medical expenses out of pocket and keep the receipts. You continue this pattern for 30 years until you're 65. At 65, your HSA contains approximately $490,000. You've accumulated $60,000 in documented medical expenses from those 30 years of receipts. You can immediately withdraw that $60,000 completely tax-free as reimbursement for expenses you paid decades ago. The remaining $430,000 continues growing tax-free. When you eventually need money for healthcare and retirement, every dollar comes out tax-free. If you need money for non-medical expenses after 65, it works like a traditional IRA. Compare this to what happens if you just paid those medical bills from the HSA each year. You'd have captured the tax deduction, but you'd have $0 at 65. The difference between these two approaches is nearly $500,000. Same contributions, radically different outcomes. Now, let me show you how this stacks with other tax-advantaged accounts. Someone in the 24% federal tax bracket who maxes out their 401k, their IRA, and their HSA is sheltering roughly $35,000 annually from taxation. That's $8,400 in taxes not paid this year. Invested at 8% for 30 years, that annual tax savings alone compounds to over $950,000. But here's what makes the HSA unique in this combination. The 401k money gets taxed on withdrawal. The traditional IRA money gets taxed on withdrawal. Only the HSA money never gets taxed if used for medical expenses. And given that the average couple retiring today will spend over $300,000 on healthcare throughout retirement, you're essentially guaranteed to have qualified expenses. The question isn't whether you'll spend money on healthcare. The question is whether you'll pay for that healthcare with tax-free dollars or taxed dollars. Most people choose taxed dollars without realizing there's another option. Let me address the concern that stops most people from using HSAs this way. The fear is that you'll need that money for medical expenses before retirement, and you won't be able to pay out of pocket. This fear is legitimate, but usually overestimated. Calculate your actual annual medical spending. For most healthy people under 50, it's somewhere between $1,500 and $4,000 annually. That includes insurance premiums paid outside payroll, co-pays, prescriptions, and occasional procedures. Can you cover that from your regular cash flow? If yes, you can implement this strategy immediately. If no, there's a hybrid approach. Cover routine expenses out of pocket. Use the HSA only for large, unexpected costs. You still capture significant growth on the portion that remains invested. Even partial implementation beats the standard approach of draining the account annually. Consider what happens during a medical emergency under each strategy. Standard approach means your HSA gets depleted immediately. You have no medical reserves remaining. The investment approach means you pay the emergency cost out of pocket or through payment plans, but your HSA continues compounding. You can reimburse yourself later if needed, or you can let it keep growing. You maintain optionality either way. The receipts matter more than people realize. Scanning and organizing medical receipts feels tedious, but you're essentially creating tax-free withdrawal rights worth thousands or tens of thousands of dollars. Every receipt represents future money you can access without taxation. Some people use spreadsheets, others use apps designed specifically for tracking HSA-eligible expenses. The system matters less than the consistency. Just keep the documentation. Now, let's talk about investment selection within the HSA. Many HSA providers offer terrible investment options with high fees. This is where people make expensive mistakes. If your employer's HSA provider charges above 0.5% in fees or offers limited investment choices, consider this approach. Contribute enough to capture any employer match. Then transfer the excess to a better HSA provider. You can roll over HSA funds once per year without penalty. Move your money to providers like Fidelity or Lively that offer low-cost index funds. The fee difference seems small, but compounds dramatically over decades. A 1% fee versus a 0.1% fee on $400,000 over 30 years costs you over $200,000 in lost growth. Inside the HSA, invest exactly like you would in any other long-term account. If you're decades from retirement, allocate heavily to stock index funds. As you approach retirement, you can shift toward more conservative allocations, though remember that healthcare expenses continue throughout retirement. This money has a longer time horizon than people initially assume. Some HSA providers require you to maintain a minimum cash balance before investing. If your provider requires $2,000 in cash before you can invest, reach that threshold quickly, then invest everything above it. That uninvested cash earns essentially nothing while your opportunity cost compounds. Let me show you how HSA strategy changes based on your age. In your 30s and 40s, maximize contributions and pay everything out of pocket. Let the entire balance grow untouched. Keep meticulous receipt records. This period builds the foundation. In your 50s, continue maximizing contributions. Begin reviewing your accumulated receipts. Calculate your total reimbursement rights. You're approaching the catch-up contribution phase at 55 when limits increase. In your 60s, you're deciding when to start accessing the money. If you retire before 65, those accumulated receipts become tax-free income sources. If you work past 65, the account continues growing while maintaining its tax advantages. After 65, you have complete flexibility. Reimburse yourself for decades of past expenses. Pay current medical costs tax-free. Or treat it like a traditional IRA for non-medical expenses. The account has transformed from a medical savings vehicle into a general retirement asset with superior tax treatment for healthcare costs. The families who implement this strategy consistently describe the same experience. It feels restrictive initially. Paying medical bills out of pocket while watching your HSA balance grow untouched requires discipline. Then, somewhere around year 5 or 7, you check the balance and realize you've built something substantial. By year 15, you're looking at 6 figures. The restriction transformed into freedom. You've created a dedicated healthcare fund that will cover decades of expenses without touching your other retirement accounts. That's the end game most people never see because they never get started. The 2 people who walked into that accountant's office at the beginning, the difference between them wasn't intelligence or income. It was information. One person understood that the HSA isn't just a medical checking account. The other person treated it like every other healthcare benefit that gets used up and forgotten. You now have that same information. You know the triple tax advantage exists. You know the receipts create withdrawal rights with no expiration date. You know the math showing how $4,300 annually becomes nearly $500,000 over 3 decades. You know that paying medical expenses out of pocket today buys tax-free healthcare for your entire retirement. What separates knowing from doing is usually just the first contribution. Open the account if you haven't. Max it out if you're contributing partially. Start paying expenses out of pocket if you're draining it annually. Scan those receipts into a folder somewhere. The actions are simple. The compounding is automatic. The tax savings are guaranteed. That $14,000 annual difference between the 2 people, that's real money that either goes to the IRS or stays in your account. Same income, same life, completely different tax bill. The only question left is which person you'll be when you walk out of that office.